Crypto's got $275 billion in tokens that are going to hit the market by 2030. There's nowhere near enough demand to absorb it. This isn't a prediction, this is locked into smart contracts right now. And in this video, I'm going to show you the math that explains why alts keep bleeding. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. Hey guys, I'm Alessandro. Welcome back to the show. Here's something people don't realize about the stock market. In December 2023, something changed. For the first time ever, passive funds overtook active funds in total assets. This is across stocks, bonds, everything. This means there's more price insensitive buyers than price sensitive buyers. They don't care if it's the market top, they don't care if the market's up or down, the money just flows in regardless. 401k retirement accounts hold $9.3 trillion. And every payday, a slice of that goes straight into index funds, straight into stocks, regardless of price. Total US retirement assets are at 45 trillion now, 62% of all equities. Vanguard's VOO, which is Vanguard's SPX, did $116 billion last year. That's more than every Bitcoin ETF combined since they launched. And then when you add corporate buybacks, over $1 trillion was bought back in 2025, which is an all-time record. It was also enormous the year before as well, in 2024, about 800 billion in buybacks happened then too. The other thing about stocks is that businesses are the best vehicles humans have ever created for turning money into more money. They generate earnings, and on top of that, there's always an underlying bid. Bitcoin has that too. Sailors buying every single dip, regardless of price. Corporate treasuries are copying him as well. Again, price insensitive buyers. They're not trading, they're just accumulating. Doesn't matter what the price is, they're buying regardless. Since January 2024, Bitcoin ETFs have pulled in about $56 billion in net new money. It's the most successful ETF launch in history. And Michael Saylor's strategy and the corporate treasuries copying have also hoovered up an enormous amount of supply. Strategy bought another $2 billion in Bitcoin just last week. On the supply side, the miners produce about 450 Bitcoin per day. About $14.6 billion per year in new supply hits the market. ETF demand regularly exceeds miner supply. There was one day where ETFs bought 8.2k BTC, about 18 times what the miners produced that day. Very clearly, demand is greater than supply. And that's why Bitcoin dominance has gone from 38% in 2021 to 59% today, because capital is rotating into the one major crypto asset that has structural demand that absorbs the new supply. And this is where it gets pretty ugly for alts. Alts don't have demand absorbing supply. They've got the complete opposite, way more supply than demand. I went through every major alt and calculated how much new supply is locked in vesting schedules, the tokens that will hit the market no matter what. And the number by 2030 is $225 billion. This is just in unlocks. We've got staking inflation as well. Every proof of stake chain is constantly printing new tokens. These tokens are used to pay the validators on the network. Solana inflates at roughly 5% a year. Avalanche is roughly 7%. ETH is 2 or 3%. And this adds another $51 billion in new supply over the next 4 years. By 2030 then, $275 billion is going to be hitting the market. So that math is already locked in. It's in the smart contracts, it's in the vesting schedules, it's happening regardless. The vast majority of those unlocks happen sooner rather than later. The 2021 VC vintage are hitting their 4-year cliffs as well. The recent tokens that were launched in 2024 and 2025, like Hyperliquid for example, again also coming into their initial cliff unlocks. 2025, 2026 and 2027 are where the most amount of unlocks have been positioned. And we saw how much damage that did in 2025. The average alt last year is down 79%. But wait, you might say, what about the ETFs? Aren't they bringing in billions as well? The thing is, it's not helping. Total crypto ETF inflows, all of them combined, Bitcoin, ETH, Solana, XRP, $71 billion in 2 years. And now the alt market has $70 billion in new supply hitting every single year. The most successful ETF launch in history, Bitcoin, 2 years of inflows is less than what the alt market needs to absorb in a single year. Even if every dollar that went into the Bitcoin ETFs had gone into alts instead, essentially it wouldn't be enough to hold up current prices. Before we continue, guys, I just want to quickly tell you about today's sponsor, 𝗕𝗏𝗏. 𝗕𝗏𝗏 is a long-running digital asset platform offering access to crypto, stables, traditional assets like commodities, all in one place. They've been operating for over a decade. They support a broad range of assets and put a strong focus on transparency and operational disclosures, including publishing reserves and balance data that many platforms still do not. One of the practical frictions in crypto is moving value from on-chain assets into everyday spending. 𝗕𝗏𝗏 offer a payment card that allows supported balances to be spent directly. Super convenient. Crypto is extremely volatile and unforgiving. You can lose all your money. There is no safety net. No one will come and protect you from bad decisions. Only get involved if you understand the risks. Thanks to 𝗕𝗏𝗏 for sponsoring this video. Stablecoins are crypto's killer app, right? The one thing that's undeniably working. So successful that Congress right now is actively debating regulation. This is crypto's breakthrough application. It's like the adoption story. The stablecoin market in the last 2 years has grown about $150 billion. Call it $75 billion a year. Alt unlocks are about $70 billion per year. So stablecoin growth is just beating the rate that the alt market is trying to exit. Think about that. The biggest breakthrough application in crypto is only just beating the current supply side issues that alts have got. When you think about that, it's crazy. Even if all of the stablecoin growth went directly into alts, essentially it would be a 1-for-1 for absorbing supply. Now, that's not actually how markets work. If you injected $75 billion into a $600 billion asset class, then yes, it goes up by much more than just the 1-to-1. But this is very clearly a supply-demand side discrepancy. But you might say, okay, now what if I just pick good projects? Real revenue, real users, that should work. And that is essentially the only thing you can do. But even that is not enough to overcome poor tokenomics. Look at 𝗕𝗏𝗏𝗧, right? 𝗕𝗏𝗏𝗧 is one of the most successful DeFi projects ever. They've got avenues in basically every successful DeFi vertical there is. They're the biggest aggregator on Solana. They've got a perpetuals market. They've got a borrow lend market. They even did $70 million in buybacks, and the token is down 89% because revenue doesn't save you from tokenomics. Total crypto buybacks across all projects was about $1.4 billion last year, and total unlocks about $97 billion. So buybacks are absorbing about 1.4% of unlock pressure. Even doing everything right doesn't protect you when the supply maths is broken. Now here's where we have to flip the script slightly, because this isn't a crypto is dead video at all. Stocks work because businesses are the best vehicle for turning money into more money. That's their fundamental reason to exist. Crypto's doing the exact same thing, and it does it faster and more efficiently than traditional businesses. Look at this chart. It shows how fast companies hit $100 million in revenue. Hyperliquid was 89 days. Pump Fund, 121 days. Axiom, 117 days. The companies that make it the fastest are in crypto. For comparison, OpenAI took 1,825 days to make that much money. Crypto businesses scale rapidly. Businesses that exist on-chain are very clearly able to scale faster for whatever reason that is. And this is where it gets even crazier. Look at revenue per employee. Hyperliquid generated over $800 million in 2025 with less than 15 employees, about $75 million per employee. Tether is very frequently given the most efficient company in the world status. Hyperliquid arguably is more efficient, but regardless, Tether, again, massively efficient company, makes loads of money, hasn't got many employees. Apple, $2.5 million per employee. Meta, $2 million per employee. Google, $2 million per employee. The numbers just don't even remotely make sense. On-chain businesses aren't just fast. They're the most capital and labor efficient businesses ever built. Perpetual futures are one of the breakthrough applications for retail being able to take on leverage. Stablecoins are an application that are essentially going to proliferate across the entire globe and already are. Say what you want about meme coins, but having some token tied to brand equity is a real thing. Goodwill exists on balance sheets. There is a world in which meme coins are essentially goodwill tokenized. These are verticals with real product market fit. They're generating real revenues. Yes, memes are not. They have tiny teams. The problem isn't that crypto is fake. It's that the tokenomics often kill the projects. The tokenomics are regularly broken, and they just struggle drowning in unlocks, especially as the market gets dead, especially as the hype leaves the market, which is what's going on right now. The actual industry is healthy. It's just most tokens are not. ARK Invest just released their report for 2026. There's entire sections dedicated to blockchain and blockchain innovation. You've only really got to look at how the adoption of Bitcoin ETFs have been to understand that this truly is something that the financial system is going to be running on in the future. Blockchain will be the backbone of financial rails in the future. It's just that right now, valuations are way ahead of the revenues they're making for most tokens, and the supply side dynamics, i.e. the amount of tokens that still need to hit the market without enough demand, are still going to be a big issue. And so when does it end? Well, the 2021 VC vintage, which was enormously high FDVs that hasn't really stopped when you look at recent launches, is still ongoing. Most new tokens have 4-year vesting cycles, if not longer. So until we churn through the vast majority of those tokens, 2021 tokens are coming into the end of their life cycle, but all the ones that were released in 2023, 2024 are mid-cycle for enormous supply side pressure. As I said at the start, we're going to see $275 billion hit the market by 2030. At the moment, the worst years for unlocks were 2025. 2026 is also going to be a tough year, and 2027, these are where the peak pain are going to be. But once we've churned through these, some of these tokens have a real chance of actually surviving. And the ones that should survive are the ones with real revenue, real users, real reasons to exist, the ones that are mostly done unlocking. They'll emerge into a cleaner market. It's by no means the end of crypto. It's just like awkward years that have to be gotten through so that the supply can actively get into the market. Stocks go through massive corrections despite being the best money-making machines on earth. Bitcoin can drop 50% even with a continual structured bid. Alts can pump even with broken tokenomics. We've definitely seen it happen. There is no guarantee, there's only probabilities. But here's the thing. On the whole, assets that go up over time share certain quality. Demand that absorbs and ideally exceeds new supply. Real businesses turning money into more money, investing in the product and producing better revenues as a result. Also, price insensitive buyers that accumulate regardless of sentiment. Most alts have none. $275 billion is coming. $70 billion in unlocks per year, including staking rewards. The most successful ETF launch in history doesn't even come close to 1 year of alt supply side pressure. The math is the math. But crypto is building real businesses. Hyperliquid, Pump Fund, Tether, these are among the most efficient companies on the planet. It's very likely winners will emerge along these lines. Guys, just one more thing. If you don't have a hardware wallet, you need one. You can't be in crypto without a hardware wallet. Everything we just talked about, the volatility, the uncertainty, the last thing you want is to lose your crypto to a hack or an exchange going down. Ledger is the industry standard. Keep your keys offline, keeps your crypto safe. There's a link in the description. Go check them out if you haven't got a hardware wallet. Don't let someone stealing your tokens be the thing that makes you get a wallet. Trust me, it really hurts. Guys, thank you so much for watching. I shall see you in the next one.